Hello, millionaires.
There are only two golden rules to become a stable earning and profitable trader. What are they? The risk management, and the second is the money management. No other strategy or tactics will give you a profit to your deposit. My experience shows that no any strategy found on the internet offers risk management within. Basically, they offer marketing and money management strategy where stop loss is not used at all. In other words, if you take a random strategy or a signal from the internet and use it together with the right risk management, the trading will be profitable. You need to focus on the process, not on the result. Money will come, then the process of finding an entry and calculating risk will be more important than earning money or beautiful charts and so on. To learn to think by profitabilities means to use the opportunity to enter here and now. Otherwise, in the minute, there will be an opportunity that has already gone. I personally advise you to take an immediately for an axiom. No one can predict price behavior in the market. Each trade can be both profitable and unprofitable before entering market. This means that you need to make a decision in total uncertainty. To control risk and capital, you should not have predetermined outcome of the event in your head, so as not to be attached to the wanted desire. However, if there is no single thought in the head about where the price will go, there is another edge, doubt and uncertainty. In order to get rid of these feelings from your head, you need to have trading statistics about your signals or strategy. How much percent a single gives profit and how much loss? How much risk can you afford for each order per day, week, month, and so on. The proper risk management you need to prepare the statistics. Collect statistics on the signal or signals, set of the signals, the so-called trading strategy. The second point is limit of risk for the order by day and month, to be able to calculate the volume of the order based on the stop loss size, to know how much you can risk during the day or month. Consider these 2 points in more detail. The first point, statistics in its impact on the trade. Then you have trade statistics. Your trading discipline can rely on knowledge about your trading statistics. This knowledge can reduce psychological pressure, and as a result, your doubts about entering into each trade will disappear. Even if your series of losses arrive, you always know that in the long run you will get profit or positive results, or at least most of the capital will remain saved. Statistics is a very good base and motivator to get your discipline under control. What does discipline mean? The ability to do the same thing and to think the same way every day. In this case, search for the same signal or set of signals. In order to collect statistics, you need to do the following. Open a terminal and start trading a random time frame, a random pair. This is important because if you use each time for testing and collecting statistics the same chart, then you remember where the price goes. But if you using random time frame and random pair, then you always get the real statistics data for your strategy or signal. And at the end of the test, calculate the following. What is the optimal stop loss? Count the number of positive and negative trades. What is the optimal ratio for orders? 1 to 2 or 1 to 3 or maybe bigger? In which part of the market, downtrend, uptrend, or flat, orders are most profitable and unprofitable, and so on. When all numbers are collected, you can analyze them. The second point, risk edges for risk and capital management. In all sources, it is advised to use a maximum of 2% risk per trade. Based on my own experience, I confirm that advice. Why up to 2% of risk? In order to have the greatest chance for a short, it means to enter the market. The more shots you have, the more likely to catch the order. The more shots you have, the more likely to catch the trade, which will give a profit at a ratio of 1 to 2 or maybe bigger. No one ever knows when the profitable moment will come, so you need to check each entry and each signal of the profitability of the outcome of an event, positive or negative. No one knows how to predict the future, but in order to catch a good order, you need to open a trade without any doubts every time you receive your signal. Otherwise, you can miss the chance, which could be long-awaited profitable move. Always use stop loss. Price is always right. All the indicators that you use are lagging. This means while are you waiting for a signal, usually waiting for a confirmation on the indicator, you are already late. 2% of risk is needed in order not to overcome the level of capital recovery. Let's suppose you have collected trading statistics for your signal on a history data or using a real account maybe. Now you can count all variables of interest. Suppose you statistically have a maximum drawdown 20%, then according to the table your level of recovery will be 25%. In other words, to get out of the 20% drawdown you need to earn 5% more. It also means that if your risk per trade will be 2%, then you may be mistaken 10 times. And the recovery you will need a little more than 6.25 trades. It's averagely 7 trades. If you increase the risk by 2 times per trade, it's up to 4%. Then you will reach the level of allowable drawdown by completing only 5 trades. And you will be needed only 3.125 trades, averagely 4 trade to restore your depot. Sounds perfect. You need only 4 trades to restore your depot and 5 trades to reach allowable drawdown. So to restore needs less orders than to reach drawdown. But however, it is necessary to take into account the psychological moment. With an increased risk, you may lose your nerves and you will not wait for take profit, which violates the rules of the risk-profit ratio and consequently the entire risk management strategy. This scenario is rather theoretical, but it will work if you strictly control risk-reward ratio for the order, minimum 1 to 2 or bigger. In real trading, if you can wait for either the stop loss or take profit, then managing risk will bring your profit. Think about it. The greater the risk per trade, the fewer trades for recovery must be made. However, you need to remember one thing which can be found in your trade statistics. A series of losing trades, in other words, the maximum number of negative trades in a row. Let's it be 6 lost trades in a row. This is taken from my real trade statistics. Yeah, I can't get exactly so many negative trades in a row. Now, let's calculate. If the risk per trade is 2%, then you can make 10 shots. It means you can enter market 10 times before you reach drawdown. Of these 10 shots, they may be 6 losses in a row. This makes minus 12% of the deposit, which in fact is less than the allowable drawdown level. If you remember, it is equal to 20%. And the following 4 trades can cover all negative trades and even earn money if ratio of 1 to 2 remains. If you have risk 4% per trade, then you have 5 trades for a shot before max drawdown will occur. Now, your series may have 6 negative trades in a row. In this case, you will exceed the allowable drawdown level earlier than you will be able to recover the deposit. If a drawdown level is exceeded, you must finish trading. Otherwise, further trading will cause irreversible losses that require even greater efforts to recover. However, ask yourself the question: if you could not earn with a 20% drawdown, then for what reason you can earn profit having a greater drawdown? Remember also that negative psychological will increase too. And the bottom line: using less risk, for example, less than 1%, probability of recovery of your capital increases many times and has a less painful negative effect on the psychology and attachment to a predetermined outcome of an event. It means price movement. The holy grail of the trading is courage within each trader to enter each trade at your signal using your entry rules, taking into account the risk per trade, it's a risk management, and the calculation of a lot or a volume, trade volume. It's a money management. No one can predict whether this trade will be profitable or unprofitable. To check it, you need to enter each signal and wait for a stop loss or take profit. Then repeat all the actions. That's it. That's the holy grail of trading. Not any strategy using any indicator will earn profit. So that's it for today, and I wish you bigger profits, and always use 2 golden rules. It's risk management or money management on your trading.